Hello there, and welcome to the first Mondays with Matthew for 2021. It's really great to be back, and I hope that all of you had a fantastic holiday season and are now getting into the new year groove. Well, there's a lot of data releases to talk about today, so let's get straight to it. First up is the latest National Association of Home Builders report on builder confidence. The index slipped to 83 from 86, but for context, any reading above 50 means that more builders view market conditions as favourable as opposed to poor. Now, as you can see, following a very impressive recovery after the start of the pandemic, US home building confidence has trended lower for the past 2 months. But to tell you the truth, I really wasn't surprised to see this. Why wasn't I surprised? Well, it's actually rather simple. Surging COVID-19 infections in concert with increasing material costs, well, that offset record low mortgage rates. Builders are still grappling with supply-side constraints related not just to material costs, but also a lack of affordable lots on which to build and labour shortages. And these are all putting upward pressure on new home prices. And that's worrying them because they fear that prices are going to get too high and their ultimately demand will slow. It is very frustrating for builders these days because they see significant demand driven by cheaper mortgages, as I mentioned, but also an exodus from city centres to the suburbs and also to other low-density areas because companies are now allowing employees to work from home because of the pandemic. Oh, and talking of work from home, I did see a number put out by the Census Bureau in their Household Pulse survey, and it suggested that there's about 38% of us, of the labour force, now working at least part-time from their homes. That is an absolutely massive number, and also one is likely to drive demand higher still. Anyway, all of the component parts of the survey trended lower, with the measure of sales expectations in the next 6 months falling 2 points to 83. The gauge of current sales conditions, that also dropped 2 points to 90, and the prospective buyers index falling by 5 points to 68. I'm not worried by this. Certainly it's a modest drop, but even at these levels, builders are still pretty bullish about the marketplace. And I say this because of the next data set I'm going to talk about, the Housing Permit and Starts report. Even if builders were suffering from worries regarding cost, by the way, I will add that the biggest issue as far as material costs are concerned are lumber prices. I did talk about these last fall, but I looked at the numbers a week ago. Lumber prices are up by 52% versus a year ago. Anyway, this increase in cost, as well as the other issues we've talked about, didn't translate into slowing activity when it came to permits and starts, which both surged in December. This chart shows the number of single-family permits issued across the country, and the figure rose by 7.8% between November and December to an annual rate of 1.226 million units. That's 30.4% higher than we saw a year ago, and it's also the fastest rate we've seen since 2007. And looking now at housing starts, well, they impressed too, with a 12% month-over-month gain to an annual rate of 1.338 million units. That's 27.8% higher than we saw a year ago. And I'd also note that single-family starts have increased now for 8 straight months. And given the data we've just looked at, it's not surprising to see a very significant jump in the number of homes under construction. Now, in case you're a little confused by terminology, I should let you know that housing starts don't actually relate to the number of homes being built. Starts, well, they refer to lots where a foundation has been poured, but it doesn't mean that vertical construction has yet commenced. For that, we need to look at the under construction data shown here, and the number is very pleasing. In fact, the current level of ground-up construction is at its highest level now since 2007. The bottom line is that I expect to see the number of starts and homes under construction continue to rise. And new supply of homes, well, hopefully it'll take some of the upward price pressures off the resale housing market. In fact, my current forecast is for new home sales to rise this year to about 988,000 units. And talking of the resale market, I know that you have all been waiting for the December existing home sales numbers, and they were released last Friday. Let's look at those. Well, before we get to the good stuff, I do want to start off with inventory, or lack of it. Without seasonal adjustment, the number of homes for sale in December stood at just 1.07 million. Now that's down 23% year over year. For perspective, that's the lowest number of homes on record, and at the current sales pace, it represents a 1.9 months of supply. Now, that's the lowest number we've seen since the National Association of Realtors began tracking this metric back in 1982. So we know that there's nothing to buy. But what's happening to sales? Look at this. Pandemic-driven demand for housing sent total 2020 home sales to the highest level we've seen since 2006. Closed sales of existing homes in December rose by just 0.7% from November to a seasonally adjusted annual rate of 6.76 million units. And sales were also 22% higher than we saw in December of 2019. As unexpected as a global pandemic was, so too was the reaction of home buyers. After plummeting in March and April, sales suddenly began to climb, and total year-end sales volume ended at 5.64 million units, and that's a number far higher than I or any other economist was predicting before the pandemic started. COVID-19 drove buyers' desire for larger, suburban homes with dedicated spaces, not just for working, but for schooling as well. And I will tell you that, in my opinion, sales could have actually been a lot higher if there were just more homes to buy. I actually wouldn't have been surprised, again, if we had no inventory constraints at all, to see a figure closer to 7 million last year. That would have matched the all-time high that we saw back in 2005. But, of course, there is a price to pay when you have so much demand and so little supply. That's right, prices, they go up. Low supply, very strong demand continue to heat home prices, with the median price of an existing home sold in December coming in at $309,800. That's a 12.9% increase when compared to December of 2019, and the highest December median price on record. I'd also add that this price is only marginally below the absolute all-time high that we saw back last October. The surge in prices really has been quite remarkable, but again, I was actually not too surprised. Yes, demand has risen significantly and supply has not, but much of the growth was driven by mortgage rates that have dropped precipitously since the pandemic started and are today over a full percentage point lower than they were a year ago. I'd also add that part of the reason we saw such a sharp increase in price is that home sales were actually very strong at the high end of the market, where there are actually more homes for sale. Sales of homes in the US priced below $100,000 were down by 15% in December, year over year, while sales of homes priced between $500,000 and $750,000, well, they were up by 65% year over year. And sales of $1 million plus homes, now get ready for this, they were up by a whopping 94% from a year ago. A lot of the growth in the luxury market, well, I put it down to mortgage rates as well. You see, jumbo rates, they spiked with the pandemic, but since that point have dropped precipitously, and that has led high-end sales far higher. Breaking out the single-family market from condos, sales leapt in the early summer, but leveled off in the fall because of, you guessed it, a lack of homes for sale and not a lack of demand. In 2020, sales of single-family homes rose by 6.3%. That's a massive number that's even more impressive given the fact that sales only rose by 0.5% in 2019. And prices were, naturally, on the rise too, increasing by 9.2% last year and that's the fastest rate of growth we've seen since 2013. And that was when we were starting to recover from the housing bubble that burst, which caused home prices to collapse, and value buyers jumped in to buy basically cheap homes, and that caused prices to rise significantly. Looking now at condos, we see a somewhat similar picture, with the annual rate of sales coming in at over 700,000. But interestingly, 2020 total condo sales were actually 0.3% lower than we saw in 2019. What's happening here is a drop in demand for urban multifamily units because of buyers' ability to work remotely. And this is also reflected by lower price growth than we saw in the single-family market. As we move forward, I'm still positive about the multifamily arena, but we are already seeing softening in demand and therefore softening in prices in some markets across the nation. And here I'm directly referring to San Francisco here in the west, and New York and Boston also back east. And as much as I think we'll continue to see short-term demand and price issues in many of these urban markets, it doesn't mean that the overall condo market is going to collapse. In fact, I think that ultimately, once we get back to normal, we may well see demand increase again. And if we start to see prices drop further, well, then I expect demand to rise even more, because buyers who had been previously priced out of many of these large cities, well, they can turn around and see that maybe they can now afford to buy, and buy they will. So there you have it, my take on the January housing-related data releases. As always, if you've got any questions or comments about the topics I've discussed today, feel free to reach out to me. I'm only an email away. In the meantime, thank you for watching. Stay safe out there, and I look forward to visiting with you all again next month. Bye now.